everyone, a very good evening. You're watching The Money Show on ET Now. I'm Mubina Kapasi. It's been quite an eventful day right here on ET Now. What's first with the Reliance Industries AGM, and then of course we had the Infosys Q1 results as well. The press conference was ongoing, and then not to mention the bounce back that we saw in the equity market and the subsequent slump that we witnessed in the last hour of the trading session. But here's what we're going to discuss on The Money Show. It's going to be related to taxation. As you will notice in your CTC breakup, there are various allowances that your CTC is broken up into. For example, conveyance allowance, the one allowance that really sticks in our head, apart from, of course, HRA and several other things. The reason why they're called allowances is because basically you pay for this from your pocket and it's a part of your CTC. However, since this is an expense incurred by you, the income tax department does provide you with some leeway over there. So basically, the conveyance expenses that you incur to go to your workplace can be deducted from your total income, and then the rest of the income is taxable. However, now that all of us are working from home, now that we really don't have this conveyance to the workplace, to the site, to the field, to the office, call it whatever, obviously there's going to be no exemption or deduction of conveyance allowance, which means that now that conveyance allowance, which was a part of your CTC, will also be taxable. So how exactly can you divvy up your CTC in a manner that allows for maximum utilization of all the deductions and allowances that the income tax department does allow for? I've just given one example of conveyance allowance, but there are several kinds. For example, motor car allowance. There's even, in fact, a leave travel allowance, etc., etc. So we are going to be talking about that, and of course, not to forget, we just have literally the last 2 weeks. Remember that FM Sitharaman did give another 1 month of an extension for the FY20 tax saving investments. Of course, right at the beginning, it was the 31st of March. It was allowed till the 31st of till the 30th of June, pardon me, because of course, the cash crunch issues that many may have faced, owing to the last-minute tax planning that a lot of us tend to do. And then finally, one more extension till the 31st of July. So far, it looks like the 31st of July will be the last date, unless, of course, the FM does acknowledge that the country continues to be in a bit of a lockdown. In that case, she may delay it again, but nevertheless, we do not want to hazard that chance, and that's the reason why we are going to tell you of those truly last-minute tips of how to make your tax-saving investments so as to ensure that your tax liability is the bare minimum. Well, to talk about all this and more, I will be joined by Jayant, CFP and Head of Products. Okay. Will be joined by he's a CFP and Head of Products with PPFAS to talk about all of this. By the way, lots of interesting changes as well have come about from the 1st of July. Firstly, if you don't pay your advance tax and self-assessment tax in time, you will once again be charged with a higher penalty rate of 12% versus 9%. Remember, this 3% leeway is something that once again the finance minister had given because I'm sure many of you may have faced cash crunch problems. So this 3% leeway was provided. However, with effect from the 1st of July, that leeway is gone, which means now you need to ensure that once again you're back to your old schedules of depositing TDS if you're a business owner, or if for all the other people to pay your advance taxes in time. Of course, the next advance tax is due only in the 15th of September. So that's one thing. And the second important topic that we're going to discuss is Section 194N, and that's with respect to TDS on cash withdrawals. Every cash withdrawal that you make is thoroughly scrutinized by the income tax department, and especially if the amount gets bigger. This is one such instance, the introduction of this section. What it basically does is it puts a TDS, which will be charged, by the way, by the bank or the financial institution. It charges a TDS on any withdrawal cumulatively which exceeds 20 lakh rupees. There will be a TDS imposed of 2%, but there is a further condition. This does come in if you have not filed the income tax returns for the last 3 years. Yes, the department will also be monitoring if you have or have not filed your income tax returns. Well, let me now, without any further ado, bring on board Jayant Pai, CFP and Head of Products with PPFAS. Mr. Pai, thank you for joining us today on The Money Show. The very first topic that I want to discuss with you is now the lack of conveyance allowance available to a lot of salaried individuals. Now that everybody is working from home, myself and my team included, this is now one allowance that will no longer be deducted, from our CTC, at least for the next couple of months. Any which ways, all of us have been working from the beginning of this financial year, and the way things are, it's going to be a while before we go back to work, which means conveyance allowance will not be there. We could assume, in a worst case scenario, for the whole of this financial year. In such a case, Mr. Pai, share with our viewers how can they divvy up their CTC in a manner that allows for utilization of all the available allowances.
Yeah, hi everyone. So conveyance allowance as such has been subsumed into something known as standard deduction for the past 2 years. So conveyance allowance as well as medical reimbursement. So formally we had to produce medical bills from the chemist, and only then we would get a tax break on that. Now both those elements are missing now because we are getting a flat figure of 40,000 per year as standard deduction. Apart from this, how friendly the salary structure is from a tax angle depends very much on the flexibility shown by your employer. If your employer is willing to structure it, especially for a few employees, and offer a standard package for others, it's very useful for that category which requires some customization. In general, there are some allowances like the uniform allowance or books and periodicals allowance, which are given for employees as long as they can justify that they require it for their job. So, for instance, people in the hospitality industry, they could get part of their salary as uniform allowance because they require it while dealing with guests. But if there's an accountant, then that person cannot justify uniform allowance. On the other hand, books and periodicals allowance could be justified by the accountant and not by a person who's, say, the general manager of a hotel. So it is very specific to the employee and the flexibility shown by the employer.
Okay, it has to be consistent with the demands of your company. It has to be consistent with what exactly is your job profile. Like, for example, if let's say you are working in the role of a nurse, in the role of a doctor, then you may be allowed a uniform allowance. This is just an example, of course. But yeah, maybe you could have a meeting with your HR department and see how you can divvy up your CTC in a manner that would essentially allow for utilization of all these allowances that the income tax department does provide. So this is just some of them. Do remember that conveyance and mobile allowances have been clubbed now. It's 50,000 rupees, in fact, is a standard deduction that is allowed. So that's, of course, with respect to the CTC bit. I want to also talk to you about something that's been introduced with effect from the 1st of July, and that is Section 194N. Mr. Pai, if you could simplify this for our viewers, what does it mean? What are the implications of this?
So, 194N actually is not really relevant for a large swathe of the population because it deals with cash withdrawals in excess of 1 crore rupees over the year from a particular payer. So this particular payer could be a particular bank or the post office. So if an SSE withdraws a sum of 1 crore or above in various installments, it doesn't have to be in one installment, during the course of a particular financial year, then the amount which is over 1 crore, with whatever amount it is, the payer, that is the bank or the post office, will have to deduct tax at the rate of 2% of that amount. So, for example, if somebody withdraws 1 crore and say 1 lakh, so on that 1 lakh, there will be a tax of 2,000 which is deducted, and deposited it with the government. So the purpose of this is basically for the government to keep track of these withdrawals, and that is the purpose of any TDS, whether it is on sale of property or on salary or whatever. So this we have seen, in some cases people withdrawing large amounts over small installments, and this is done. This has been introduced with a view to getting them into the tax net. So this really is not very relevant for most of the population, I guess.
All right. Okay, understood. Now, Mr. Pai, just a clarification is what I wanted in this section 194N. Yes, you're right. It actually may not apply to a large segment of our population. But it mentions that if your aggregate withdrawals exceed 20 lakh rupees, so let's say if I have a savings account with SBI, with HDFC Bank, with Axis Bank, PNB, so on and so forth, does it mean that all of my withdrawals from each of these banks should not exceed 20 lakhs?
It is from each bank. So if you withdraw a total of, say, okay, I'll give you the further nuance on this since you mentioned this. So there is this stipulation that in case you haven't, paid your tax over the last 3 years, only then there's a further TDS of, then there are two categories or two buckets. From 20 lakhs to 1 crore, it is 5% deduction, and above 1 crore, the same 2% applies. But whatever it is always the payment made by a single payer. So in this case, since you mentioned 3 banks, it is the amount that you withdraw from each bank which counts and not the total amount.
Okay, understood. So that's basically about section 194N, a clarification over there. And now, of course, Mr. Pai, we have just literally the last 2 weeks, unless the finance minister, decides to extend this date again. But yeah, we literally have now the last 2 weeks to make those tax-saving investments for FY20. Yes, folks, if you still haven't made it, then don't wait any longer. This is literally the last 10 odd days that you have. Mr. Pai, help our viewers out there. What should be their go-to tax-saving investment, not just for FY20, but for FY21, etc., etc.
Yeah, you rightly mentioned that the same strategies should apply across financial years. So the first thing is that in case you haven't taken that first step towards tax saving, don't panic. You still have a few days. And today with online facilities available, you can do the whole thing in a day or two. That's one thing. But in a state of panic, don't take steps which may save you tax today, but which are harmful for you in the longer run. So, for example, taking a life insurance policy which you don't need, or getting into some tax-saving deposit which actually it does not even give you returns equal to inflation, all those things. Before you decide which investment option to choose, you have to first estimate your tax liability. Based on that, you will have to make the investment. So, in case you don't have a very hefty liability, you don't have to really maximize all the amounts available under various sections. So, for instance, under ATC, you may get a benefit up to 1.5 lakhs, but you may not really need to invest that much or to spend that much. So, that's the first thing. Second is, even though you feel you have not yet taken the first step, during the course of the year, there are several expenditures that you may have undertaken which actually go to help you to save tax. So, for instance, your life insurance premium is one such expenditure, children's school fees, your health insurance premium, your NPS contributions. So, all these, will add up and help you save tax. So, before you blindly invest in something just because, you only have a few days to go, first assess the big picture and only then decide where you want to invest the incremental amount. Because it may so happen that you need not, undertake a single rupees investment because your tax planning is already done during the course of the year and you are not aware of it.
Oh yeah, that's absolutely true actually. In fact, you must also take into consideration when assessing your tax liability already the TDS as well that has been cut, by your employer or by, your bank, etc. Okay, you know what? On that note, we are going to take a very short break. We haven't done that in a while now, so we will take a very short break, but Mr. Pai will be with us to get your questions and queries answered. Don't go anywhere. Okay, welcome back. You're watching The Money Show on ET. Now, we've been in conversation with Mr. Jayant Pai on what's a good breakup for your CTC to be able to extract all the benefits that the Income Tax Department does allow in terms of allowances, in terms of deductions and many other things. And of course, not to mention the last couple of days left for you to make your tax-saving investments, unless, of course, once again, if Mr. Sitaraman decides to extend the date again. Okay, well, time to take on board your questions and queries. We've received quite a few of them, so let's get straight to it. Srinivas Rajagopalan has emailed us saying that he had invested roughly 26,400 rupees in the L&T Ultra Short Term Bond Fund. This was way back on the 4th of November 2019. He redeemed it on the 17th of Feb 2020, wherein he made a profit of roughly about 418 rupees. He has sold it, that means in just a span of, 4 odd months between November and Feb. He wants to know how should he calculate short-term capital gains for this amount. It's just 420 rupees, and yes, there is a fixed amount that you have to pay. The rate is fixed rather. It's not basically how simply added on to your total income and then you calculate tax. So Mr. Pai, how would you help Srinivas?
Yeah, actually, in case of all debt funds, only if you sell the units after a period of 3 years, do you get the benefit of long-term capital gains tax. So there you are charged at a flat rate of either 10% or 20%, 10% without indexation or 20% after indexation. Any sale which is incurred prior to 3 years attracts tax at the same rate as your tax slab. So if Mr. Srinivasan's tax slab is 30%, he'll have to pay roughly 125 rupees on this amount of 415 odd rupees. He'll have to pay tax of around 125. If his slab is lower, he'll have to pay a lower amount accordingly.
Okay. All right. So I stand corrected over there. This bit will basically be added to your income. So whichever slab you are in, you'll accordingly pay taxes. Okay. Let's take on board our next query. It's coming in from R.K. Khanna. He says that I'm a retired personnel from private service. He is also above the age of 65 years. So he's basically a senior citizen. He wants to know if he must pay advance tax on a self-assessment by the 31st of July, or should he pay it by November, the 30th of November, which is the last date for filing your return for FY20. Okay, what I understand from his question is, and I guess it's a very valid one, any taxation that you calculate on your own prior to the 31st of March would be termed as advance tax. Then between the 31st of March till the date of filing return, ordinarily it's 31st July, but of course Mr. Sitaraman has given that extension. So this time around it's till the 30th of November. That would be called as self-assessment tax. Now he wants to know if it will be considered as SA tax even if he's paying his tax till the 30th of November. A valid question over there, Mr. Pai, now that the dates have been shifted here and there. What is your assessment of the case?
Yeah, so actually his case is not as complicated because as per a change in Income Tax Act around 8 years ago, any SSC above the age of 60 need not pay advance tax. So that's a big relief to a large segment of taxpayers. So he has to only pay self-assessment tax by November 30th. In case he was liable to pay advance tax, then the same set of rules apply. He would have to pay that estimated tax in 4 installments on the 15th of June, September, December, and March. and if he did not pay, he would have to pay interest on the delayed payment and all that. But since he is above 60, it's quite simple. He does not have to worry about advance tax at all. He has to just pay the tax that he assesses based on his calculation by November 30th. Usually it's July 31st. This year it has been extended.
All right. Yeah, well, that's an important clarification. Anybody who's a senior citizen does not actually need to be worried about paying advance tax. That they've been exempted from paying advance tax. But of course, that does not mean you have to make your tax payments. You can make even the tax payments after the financial year is over. All right. Let's take on board our next query. Siddhartha Chakraborty writes into us saying, on my father's demise, my senior citizen mother has inherited his shareholdings. Our individual here, Siddhartha, is now the nominee. In his income tax declaration, he would declare the yearly dividend received as non-taxable, since the tax would have already been deducted, before dispatch of the dividend to investors, basically in the form of dividend distribution tax. This was definitely the case till March 2020. But of course, then we had FM Sitaraman taking away DDT and making dividend taxable in the hands of the shareholder from this assessment year onwards. Now he wants to know, what is the treatment of dividend at present as before or different? And what about the interim dividend that they have received after the receipt of the standard yearly dividend? So for example, he's received dividend income on the 30th of July 2019, and he's also received interim dividend on the 9th of March 2020. So Mr. Pai, what would be the treatment of these two dividends that he has received?
So everything has to be seen through the prism of April 1st, 2020. So any dividend received prior to that, it will be the amount which is credited to the shareholders' account after deduction of the dividend distribution tax. So consequently, it means that shareholders need not pay any tax on the amount they receive. So that's very simple. The complication arises after April 1st. So in his case, his mother has inherited certain shares. So from the date of inheritance, any dividends received by her on the shares which were formerly owned by his father will not be liable to any dividend distribution tax in line with the changes announced in the recent budget. So what that means is, in case his mother receives say 100 rupees as dividend, that 100 rupees will be treated as her income and taxed as per her income tax slab. In the earlier case, now also one thing, the dividends earned by his father prior to his demise, all those dividends will be treated as part of the father's income, and tax will have to be paid accordingly, along with the usual deductions and exemptions which are available. Only the dividends received by the mother hereon, after getting the shares, she will have to pay tax on that income, just like tax on any other thing, say like bank interest or whatever. They are all treated as part of your income and taxed according to your income tax slab.
Okay, so only after inheritance, the dividend that is received, that will be taxable in the hands of the mother. And Mr. Pai, just correct me if I'm wrong, if I misheard you over there. You basically mentioned that any dividend received after the 1st of April 2020, that is the dividend that will be subject to the new treatment, which basically means being added to your income. Am I right?
Yes, that's correct, yeah.
Okay, all right, fine. So do remember, folks, any dividend that you guys have received after the 1st of April 2020, which means this current financial year, all of that will now have to be added on under the subheading other income, and that will be added on in turn to your total income. The whole thing will be taxable as per your regular tax slab, whether it's 10%, 20% or 30%. All right, time for just one last query. Manish Keswani writes into us, if you have a joint property being held between a father and a son, can the son claim the HRA benefit if he pays rent due to his father due to financial requirement claimed by the father? So maybe the father has only this rental income as his source of income. So the son wants to know if he can in turn claim this as his HRA, even though the property is, by the way, jointly owned. Mr. Pai, what's your assessment?
Unfortunately, he cannot. So in the ordinary course, children can pay rent to their parents, and the parents must display that income in their return. But here, even if his father is willing to do that, the rules say that you cannot pay rent to yourself in a sense. So jointly owned properties are partly owned by the SSC also. So co-owners cannot pay rent on properties owned by them. So so here he will not be able to claim HRA benefit, even if his father shows it as income in his return.
Because are very clearly a co-owner, you cannot be paying rent. That's of course, it makes logical sense as well, right? You won't be paying rent if you're living in your own property. Okay, great. Mr. Pai, really appreciate you joining us today and, helping all of our viewers out with their questions and queries. Thank you so much for joining in. We will take a very short break right here on the show. This is the Mind Show.